All right, welcome investors. Today, we're diving deep into a market that, well, it truly never sleeps. We're talking about a place where a single headline out of the Middle East, or even just one ship getting stuck in a canal, can trigger billion-dollar swings in the blink of an eye. Of course, I'm talking about the global oil market. It's the lifeblood of the world economy. And look, understanding its pulse is absolutely critical. And I don't care what you trade, stocks, crypto, forex, because the price of oil is baked into the cost of pretty much everything we make, everything we buy, and everything we move. So let's get into it and break down the forces that drive this incredibly volatile market. So let's kick things off with a day that I'm pretty sure still gives traders nightmares. April 20th, 2020. Now, that number you're looking at, that is not a typo. On that day, the price of a barrel of West Texas Intermediate crude oil cratered to negative $37.63. I mean, just think about that for a second. It means you literally had to pay someone almost $40 just to take a barrel of oil off your hands. Trading screens were just a sea of furious red, brokers were screaming at their clients to just stop trading, and entire accounts were just wiped out in minutes. So how on earth does the single most vital commodity on the planet end up with a negative price tag? I actually know a futures trader in Singapore who told me he watched a colleague of his smash 2 keyboards and a laptop in about 30 minutes before just walking out and deciding to go on a 10-day meditation retreat. The answer, though, it really reveals the brutal physical mechanics of the market. It was a perfect storm. You had demand collapsing from global lockdowns, a massive supply glut from a price war, and, this is the critical part, a complete and total failure of storage. There was simply nowhere left on the planet to put the physical oil. It was a harsh lesson that in the oil market, financial theory can and absolutely will collide with physical reality. To really wrap our heads around these kinds of shocks, we need to break down the core forces that create all this intense, short-term volatility. You know, I like to think of the oil market like a massive glass table that's holding up the entire global economy. It's incredibly strong, sure, but a small stone, thrown at just the right spot, can shatter the whole thing instantly. So the question is, what are those stones? Well, it really boils down to these 3 incredibly powerful drivers. You can think of them as a kind of triumvirate, where each one has the power to send massive shockwaves through the financial world. First, you've got OPEC+, which basically acts as a global central bank for oil, controlling the supply spigot. Then there's the ever-present geopolitical risk, largely centered in the Middle East, where something like a third of the world's seaborne oil passes through. And finally, you have the wild, unpredictable swings in global demand, which kind of acts as a real-time report card on the health of the world economy. Look, trying to trade oil without understanding OPEC+, it's like trying to trade forex without watching the Federal Reserve. It's just not going to work. And the market's reaction to their decisions really reveals a core psychological truth. Take October 2022, for example. When OPEC+ merely announced they were going to cut production by 2 million barrels per day, the price immediately shot up. Why? Well, it's because the market doesn't wait around for the physical barrels to disappear. It prices in the future, instantly. The announcement itself is the event. It reshapes expectations and triggers algorithms to buy long before the reality of the cut even sets in. This quote, "Man, it became terrifyingly real on September 14, 2019. In a single morning, a drone attack hit Saudi Arabia's Abqaiq facility, which is the world's largest crude oil stabilization plant, and it crippled half of the kingdom's entire production capacity. The price of oil didn't just rise, it exploded. It jumped 20% in the single largest daily surge in 28 years. That one night proved, without a doubt, that oil infrastructure is a target, and any conflict in the Middle East carries a built-in risk premium that can detonate at any moment." And then, of course, you have the demand side. The oil market is frankly more sensitive to economic indicators than even the stock market. I mean, back in 2022, every single time news broke that Shanghai was going into another lockdown under that zero-COVID policy, you'd see oil instantly drop 3 to 5%. On the flip side, if the US Federal Reserve makes a statement that the markets even think is a sign of a coming recession, oil prices will fall like a stone. It makes sense, right? China is the world's biggest importer. The US is the biggest consumer, so their economic heartbeats basically dictate the rhythm of oil prices. This event really shows just how fragile the whole system is. You see, you don't always need bombs or major policy decisions to cause a crisis. Sometimes, all you need is one very, very large ship, the Ever Given, turning sideways in the Suez Canal. I mean, this single, almost comical accident blocked 12% of all global trade. And the result? Brent crude jumped 6% in 24 hours. It was a perfect, if painful reminder that the arteries of global trade are incredibly narrow and incredibly vulnerable. Okay, so now that we have those drivers in mind, let's see how they've actually played out across history. By looking back at the market's biggest storms, we can start to see these predictable patterns in its psychology, patterns that honestly repeat themselves over and over and over again, and they offer some really valuable lessons for any investor today. Each one of these events was a defining moment. The 1973 embargo, that taught the world that oil wasn't just energy, it was a political weapon. And that's a lesson that echoes in every sanctioned regime we see today. Then in 1990, the invasion of Kuwait showed us that just the fear of a disruption was enough to double the price. And then 2008, that was a brutal lesson in demand destruction. The global financial crisis just vaporized consumption, sending prices from an all-time high of $147 down to below $40 in just 6 months. And most recently in 2022, the war in Ukraine demonstrated how a conflict involving a major producer can trigger a global inflation crisis, forcing even crypto traders to start watching oil charts every single day. So, out of all this historical chaos, a really crucial pattern emerges. It's a mantra that every seasoned trader lives and dies by. Buy the rumor, sell the fact. In almost every single crisis, the oil market prices in the absolute worst-case scenario before the event even fully unfolds. I mean, when Iraq invaded Kuwait, prices went crazy on the fear of a wider war. But the day the actual military response began, prices fell, and sharply, because the uncertainty was gone. The key, for you as an investor, is to recognize the peak of that rumor phase, when speculation is just off the charts, and to understand that the market moves on anticipation, not on confirmation. Okay, so what's the bottom line here? Why does any of this actually matter to you? If your portfolio's in stocks, or forex, or crypto, why should you care about OPEC meetings or weekly inventory reports? Well, the answer is simple. Because oil is your early warning system.
Think of it this way. Oil is the global economy's most sensitive sensor. It reacts before other assets even see the danger coming. A spike in oil, well, that directly fuels inflation, which forces central banks to raise interest rates, which puts pressure on growth stocks. A flare-up in the Middle East, that triggers a risk-off wave, and that's when investors sell what they see as speculative assets, like crypto, and they flee to safer havens. It dictates corporate earnings for entire sectors, and its volatility is often the canary in the coal mine for volatility across all financial markets.
And right here, you can see that cause and effect relationship in action. This isn't abstract theory, this is a playbook. You see an oil price spike, you should immediately start thinking about inflation and what the central banks are going to do next. You see a headline about a new conflict in the Persian Gulf, and you should be anticipating a shift away from risk assets. You see signs of a major demand crash in oil, well, that's a crystal clear signal to be really wary of the upcoming earnings reports for cyclical sectors, the ones tied directly to the health of the economy, like airlines, transport, and manufacturing. Understanding oil gives you a predictive edge. So the next time you look at an oil chart, I want you to see more than just a number. You are seeing a story of war and peace, of economic booms and busts, a story of fear, of greed, and of the huge political decisions that shape our world. The price of oil is the narrative of geopolitics and global finance, and it's playing out in real time. For the investor who knows how to listen, it offers the clearest signal of what's coming next, long before it shows up anywhere else.